Joining me now for a closer look at what's playing itself out on that market scene is Stanlib's Nesi Chetty. Nesi, a pleasure. Good afternoon.
Hi, good afternoon to you and your viewers as well.
Keen to just maybe start off the week, Nesi, looking at the weekend. I don't think we can ignore anything that happened over the weekend today and Monday, and I could be reflective in markets. Is that the case?
Yeah, I think certainly you hit the nail on the head. I mean, it's been a volatile last couple of days. I mean, since we had the Iran attack on Israel, certainly geopolitical risk has increased across the board. I think at this point in time, I mean, we still have no idea what the response from Israel will be. And I think if I look at the US intervention, I mean, Biden and the broader European zone are sort of urging restraint. But we saw, if I look at commodity markets, we had that rise in oil initially. And then that pullback over the last couple of days. So the things we are sort of monitoring is, I mean, is there going to be a longer run impact on the oil market? And potentially if there will be supply disruptions on a regional basis. I think if you look at it well, I mean, the US have come out strongly saying it's a counter attack. I mean, they're not supportive of that. But certainly if I look at oil now, and I think that's the big, the base case for tensions to remain high, to underpin prices. And I think if I look at the oil market, what's been priced in the current market view is that maybe a potential continuation of the direct conflict between Iran and Israel. So it could mean oil trades higher, and if you add supply disruptions, it could be worse as well.
I must ask you, Nesi, it does look like we're moving into a risk-off, kind of market. But that's been the kind of the way we've been moving over the last 2 years or so, trying to manage inflation. I'm wondering if, we could see any more risk-averse behavior on the markets and what that might look like, considering the uncertainty that you make reference of.
Yeah, I think the pendulum between risk on and risk off is very correlated, I guess, to inflation and the Fed's commentary as well. I mean, we've seen a broad array of inflation data come out from the US, some positive, some negative. And if I look at the big three components like shelter, that's still high. It's proving to be stubborn. We've seen also, I guess, motor insurance costs have gone up in the US for a variety of reasons. So the narrative is Fed members across the board are becoming a lot more divided now. On not just inflation outlook, but also the rate view as well. I mean, at the beginning of the year, as a business, most investors would have been looking for probably 2 to 3 interest rate cuts. Those expectations have adjusted quite a lot, given the recent inflation prints. And I think we're at a stage now where we're in an election cycle. The path to inflation looks a lot more bumpy than it did maybe 6 months ago. And we don't see any maybe moderation in shelter inflation, which means potentially we're heading to an environment where we could potentially be in a probably 1 interest rate cut in the second half of the year, which has, I think, markets in a flux as well. So that's a big concern versus what's been priced at the start of the year.
I'll also ask you, when we hear news of the fact that Apple saw iPhone shipments plunging there, could we say that device or gadget sales, Nesi, can be a proxy for the health of a consumer? And now that we're seeing shipments, possibly plunging, that's also demand, pulling back, and that's evidence of consumers that are strained everywhere throughout the world.
Yeah, I think that's a very that's a good observation, that if we look at US consumer strength historically, given where we are in the savings cycle, I mean, the consumer is definitely under stress. And if one looks at the big durable items, particularly where they'll rein back purchases, that would count as one of them. So we certainly see broad categories of the US consumer market coming off. But you'd start to see that, I guess, in top line sales as well, where when these companies report results, you see a slowdown in, I guess, revenue over the period.
Also keen to get your thoughts on Barloworld and their cautionary released today. It said a lot, but it also said very, very little.
Yeah, it's a bit difficult to sort of read into what potential transaction they're looking at. It could be either a big acquisition, which would require them to put out that sense that they did today. But I think it's something significant that will sort of, I guess, when they release the details, you'll be able to unpack what the transaction looks like and whether it's going to be a combination of debt or cash.
We'll be watching for that one very closely. Also keen to get your thoughts on Ceres Real Estate. I think they've managed to eke out a decent set of numbers considering the operating environment here. 8.2% increase in overall rent roll for the year.
Yeah, it's one of the better quality operators, I think, of branded business parks and industrial parks. I mean, they compete in that flexible storage space. They made a big acquisition in the UK. The German market, they've been historically strong. So as you pointed out, I mean, the like for like, they did quite well, 7.2%. They're a business that's, I would say, vertically integrated. So the asset management on the property side is done in-house. In both the UK and German market, rent rolls will continue to grow. And in particularly in the UK, they're achieving above average inflation. If I look at Germany, I mean, the increase in rent rolls, they're benefiting from increased occupation. So very much a focus on driving rent growth in the short term, which should offset some of the yield movement we've seen upwards in those markets. Look, they've done well on the I guess, the funding side as well. They were able to come to market and raise about 165 million euros on a oversubscribed equity raise, and that they'll look to deploy into the pipeline. And they've been quite busy with disposals as well. I mean, they would have disposed about 51 million euros of properties over the last 6 months, and that they did at close to book value. So with regard to risk in these type of businesses, I mean, the refinancing risk, I would say, is somewhat moderated, given that there isn't any significant debt maturities until probably 2026. So you are getting the benefit of positive leverage as well. And it's a share, I think we've highlighted it before on your program, that it shows quite a bit of value.
I'm surprised, Nesi, that actually commercial properties have actually fared okay over this high interest rate environment. We haven't heard of any distress there. I'm wondering if that's got to do with maybe balance sheet strength, or even though, we saw very difficult macroeconomic environments, they just weren't so strenuous that commercial property would be in distress.
Yeah, I think you had a sort of a dislocation between the bonds and the properties as well. If one looks at the property market, I mean, they went through a period from COVID where there was a lot of rebasing and repricing on underlying assets that have happened. You've got to a stage now where NAVs are more sustainable. So the assets that are being sold in the market are more reflective of what the true price should be. So we've seen, I mean, a lot of companies sell it very close to book value. This year, if I look at standout performance, retail's held up quite well. In that retail market, I mean, although the consumer's under stress, there's still a big spend on food, which have meant that those companies exposed to that end of the market have shown positive trading densities. I think also, if you look at the big refinancing that's happened, the market's repriced the big move in interest rates. Potentially, when rates come down, you do get a bigger benefit on finance charges, but that's probably 12 to 18 months out.
Well, Nesi, I'm keen to get your stock pick in a bit, but first I'd like us to reflect on counters that have found favor with your industry peers.
I think that there's been some pretty decent action on the platinum group metal side of things, but a lot of the stocks have already run and they've only exposed to platinum group metals. And I started thinking about poor old African rainbow minerals, that the share price has been under so much pressure because of pressure on PGM pricing. But it seems as if the market forgets that they have a big iron ore exposure where pricing has held up well. And they also have a big stake in Harmony Gold. And Harmony's share price continues to climb quite strongly. I don't think African Rainbow Minerals share price reflects that accurately. And if you strip out Harmony Gold, that stock trades at very low multiples. So I'm thinking that it could re-rate from here.
At the moment, as I said, there's a lot of sort of uncertainty of where the market's moving. We've seen much more breadth in the market. So we're actually moving away from specific positions that we have capitalized on that's done exceptionally well, especially on the tech side. And we're putting it into a broader based beta play, so ETF play of the US market, really. And that's actually giving us sort of a broader exposure to some of the areas in the market that we're seeing recovering at the moment, that's adding value, despite tech coming back a little bit due to the higher valuations. And now with the CPI print we had this past week, there is even a bigger normalization of the market, and that's what we've seen over the last couple of days. So we like the broader market exposure. So as I say, an ETF that gives you the exposure of the larger market, or the S&P 500 in the US.
All right, Nesi, keen to get your thoughts on some of those, as well as the S&P 500 ETF.
Yeah, so I think if I look at the ETF, I mean, if you're an investor and you're looking for offshore exposure and you're looking for, I guess, broad exposure, the ETF does tick that box. The one thing you must be mindful of is if you look at performance in that in the S&P, I mean, a large chunk of the performance last year came from Magnificent Seven. So, I mean, the Teslas, the Apples, Nvidias. And those companies drove, I guess, 90% of the market return. So if you're expecting an environment this year where rates come up in the second half of the year, and the other broader categories like banking, consumer services, media, everything outside of let's call it Mag 7, showing improvement, then the ETF makes sense. You're getting also, I guess, broad-based diversification across multiple sectors. African Rainbow is an interesting one because I think if you look at the particularly the PGMs, yeah, I mean, they have run particularly hard, and African Rainbow hasn't been a beneficiary of that. There could be some value unlock. I mean, the market hasn't necessarily put the proper valuation on the Harmony re-rating. And if you strip that out from the valuation, sure, the core business looks very cheap. So they could be definitely upside from there. And I mean, they do have good iron ore exposure, which over this period has been stable. So I think both of those are sort of, I mean, fine in terms of where the relative value is.
With that said, Nesi, which counter are you loving this afternoon?
Yeah, so I mean, the one we've liked, and I guess it's better quality retail REIT exposure has been Vukile Property Fund. It operates both in SA and Spain. And if I look at it over time, I mean, the Spanish portfolio has got to a size where it's bigger than SA. It's at about 1.1 billion euros. Close to 20 billion plus versus SA with 15. We like that, I guess, that tilt in the portfolio over time. Like for from SA is about 4.5% NOI, but it's strong. I mean, very little vacancies that they need to deal with at 2%. And interestingly, in the SA portfolio, they're seeing positive reversions in retail at about 2%. Castellana does give optionality. It's foreign currency earnings. The Spanish market is growing. Very little vacancies in that market, so the NOI is quite high, 9%, although we think it will stabilize over time. And particularly in this business, I mean, the refinancing costs, or what we would think the heavy lifting has been done in that portfolio already. Castellana has no debt that they need to refinance, and the big maturity is in 2026. It's a business, if we look at where the opportunity is, certainly in the valuation on the portfolio. I mean, SA yield sitting at about 8.8%. The European yields are closer to 6.4. Those are two areas where we think on a 2 to 3 year view, yields could come down. I mean, they've done a successful capital raise. There've only been 2 companies in the market that have done that year to date, Spear and Vukile. And certainly, if we look at the forward yield at about sort of 8% plus, you're paying for stable distribution growth. And there's the underpin that the discount to NAV could close over time. So it's one we like. We think it's cheap, and it's a good share to have in your portfolio.
Brilliant, Nesi. A pleasure having you this afternoon. Thank you so much for your time. That was your midday markets update with Stanlib's and Nesi Chetty.